Hi, this is Brian Vendig again from MJP Wealth Advisors. Just wanted to provide a little bit of an interim market update as we are sitting here in mid-July ahead of a Federal Reserve announcement on interest rates, and we're at the preliminary start of earnings season. So I thought it would be a great time to check in with you all. Obviously, we're also in the middle of summer, so I hope everyone is having a chance to enjoy some nicer weather. I know it's been a little rainy and hot this year, but I think we're all doing the best across the country to take a little time and enjoy the summer. So with all that being said, let's just jump right into it. I think this year has been really interesting for investors because we've seen the market grind higher, but it's primarily been led by only about 8 to 10 stocks. And that's caused a little bit of confusion for some of our investors because the mega cap technology stocks led by the AI frenzy, which is any company talking about how they're making investments in artificial intelligence, has really contributed to about 90% of the returns that we've seen this year. And when you just look at that segment of the market and you think about what investors are paying for growth right now, it's about 29 times forward-looking earnings. And the historical average of the market is around 17. So right now in this environment, it seems like investors are paying up for growth because of uncertainty coming from other areas of the economy right now. And that's really been the theme, I would say, for about the first 7 months or so this year. So if we take a step back and we look at this year in total, we've seen, yes, these positive returns coming from the market from 8 to 10 stocks, while 490 really haven't participated, like I said, and that's because investors were concerned about a U.S. recession. And I know you remember my prior videos where I said part of the main reason why the market traded down last year in 2022 was because of a concern in 2023. Earlier this year, we framed that we thought this year the market had a probability of going to a recession around 50-50, if you recall. Just a couple months ago, we reframed that and said, no, we do not see a recession for 2023. And because of that, I think that's what led investors being a little bit more comfortable in taking risk and also seeing the fact that inflation numbers have eased, again, not as fast as we all hope, but have been easing over the course of this year. So keep in mind, about 13 months ago or close to 12 months ago, inflation was sitting at around 9.1%. Now we're looking at inflation year over year higher by about 3% or so, and core inflation being up in the middle to the high fours. That's progress. Now, the other part of the discussion is the Fed. Last year, we saw rate increases go up over 5% in a very short time period. Now we're going to hear from the Fed on Wednesday, July 26th, and they're going to raise interest rates another 25 basis points or 0.25%. Now, why is that? It's because year over year, people are making 4.4% more in their wages, and they're concerned about wage income, which is a huge part of inflation, staying sticky and keeping inflation elevated. So they want to keep fighting that good fight, as they would say. But the reality is another increase of interest rates will continue to add to the burden of consumers continuing to expend at certain levels that they've had over the last 12 months or so. And so as a result, we think that this next rate increase is going to continue to add a little bit more force to this blunt tool that the Fed is using to slow down demand and slow down the economy. Now, what does that mean for your portfolios and what does that mean for our outlook moving forward? Well, let me try to give you a couple points there. Number one, we think the Fed is at the end of this rate increase cycle. It's possible, and I would call it a jump ball, to use a basketball metaphor for all those UConn fans out there, that the Fed might not increase in September. We really have to see how the data comes in on inflation over the next couple of months. And it really depends on that push-pull between commodity prices, food prices, autos, housing, wages, where the Fed is going to look at the mix and make a decision. I'm optimistic that they do not raise rates in September because I don't think they need to. I think this month-over-month decline in interest and in inflation will continue. I don't think you need to raise rates anymore to combat that. And we do expect inflation on the core level, which is backing out the impacts of food and energy, to get down to around low 4% by the end of the year, maybe around low 3% by next year. So that's point number one. So let's not focus so much on the Fed. Let's then come back to then the next point, which is the economy. So the economy has been supported by a very active consumer that has been spending, as I just alluded to. However, that spending is not going to continue. We do not think that spending is going to continue at the same levels that we've seen over the last 12 months. The consumer is shown to still be spending, but not spending as much. We've got a recent read last week on retail sales that came in slightly lower than consensus. Auto loan defaults going up, credit card balances going up, household savings going down. Consumers still going to spend, but I think the services part of the economy, which is supported by spending, and again, that's 70% of our economy, as I said before, is going to slow. So that means these rate increases, consumer getting a little tired. We're expecting over the second half of the year, the economy to continue to slow, but not a recession in 2023. Probabilities are a little higher for 24, but who knows? The way this economy is going with all the conflicting variables, I'm not saying the Fed's going to have a soft landing, but I'm just saying it might be possible that this economic malaise or this rolling recession, as we've characterized before, continues into next year. So it might feel like a recession, but someone in the government might actually not declare it. So that one I would say is a wait and see. But the most important thing that we have to focus on for the balance of the year into next year is earnings. And we're in the middle of the earnings cycle right now. We want to hear from publicly traded companies of all different sectors to let us know, how is business going? How are they maintaining price and profitability in this unique market environment, economic environment? And how are they going to forecast that profitability moving forward? And how do they feel about that? Those are the most important things to hone in on in the second half of the year, not what the Fed does. And it makes sense to pay attention to inflation, don't get me wrong, but I think it comes back to the fundamentals. And what we're seeing right now in the market is that there's a group of companies, approximately 490, as I said, who really haven't participated in that rally. And I think as the economy continues to slow, we're going to see the value-oriented stocks participate a little bit more in the second half and catch up with where mega cap technology has set the bar. We're also going to see, I think, some opportunity coming from smaller companies who have been disproportionately impacted going back to March due to the concerns about our banking sector. And again, keep in mind, smaller companies, smaller balance sheets, less access to credit. Investors were concerned, traded those down first because of concern about a recession being around the corner. That recession concern, and the market agrees, is not appropriate. Then small caps have an opportunity to rally because usually they're the first to go down, the first to come back. So that's something that we might be adding to in your portfolios over the next couple of weeks. We also look at the market possibly pulling back a little bit over the next couple of weeks, because if the mega cap technology stocks don't price their earnings outlooks and numbers to perfection, some of those leaders might give up a little bit of some of that froth because the market might have gotten overextended. But that's where we see value stocks like basic materials, healthcare, industrials having a chance to shine over the second half of the year, and investors appreciating a dividend and a stable cash flow to offset the opportunity of investing in growth and risk for the longer term. So when you kind of put it in a nutshell, what am I saying? I'm saying that we are optimistic about the market over the next 12 to 18 months, because if those earning outlooks hold true and inflation continues to come down and the heavy lifting from the Fed is finally over, then let's come back to the fundamentals and look at profitability and look at expansion of earnings as a way to continue to support value and lead the market higher. And that's our view moving forward. Now, again, there are troubled waters ahead. We know it's an election around the corner. There's geopolitical risks. There are also the risks that inflation might come back, and maybe the Fed still has some heavy lifting. That's why we're staying very focused and very diligent, and we appreciate the privilege and opportunity to help you and your family and your business and your friends in managing your assets and being your advisors. So thank you so much for your continued trust and support. And please look at any opportunities or changes that we're making in your portfolio as a reaction to what the fundamentals are giving us in the market. So any pullback, again, we're looking at that as an opportunity. Any changes in monetary policy, we will adjust accordingly. And any changes in any policy decision coming from our friends in Washington, we will keep you posted and make sure that those things are comprehended in your portfolios. And again, if you have any questions, please feel free to reach out to a member of your wealth advisors, of our advisory team, or myself. We're happy to answer those moving forward. So thanks so much. Enjoy the rest of your summer. And again, appreciate all your trust and support.